If you pay attention to global macro or trade currencies, then you should pay attention to what Professor Steve Hanke has to say. Now, he is not an ordinary, normal professor, someone who has limited or no real world experience, an academic, a bookhead, an egghead. He has been hired to be the head of currency trading at investment banks and hedge funds. He's consulted for those for currency trading. And also, after governments have had currency collapses, he was hired as a consultant to help set up the currency and stabilize it. So after currency collapses in the last 20, 30 years, he's been hired to help stabilize currencies. Recently, he put out a very interesting article with an interesting chart of all the currencies that have had massive devaluations against the US dollar since January 2020. So this week, in a single day, the Turkish lira dropped 17% in a single day against the US dollar. Now, normally for currencies, that is very rare. Maybe for emerging market currencies or basket case currencies, that is not. But in the past, prior to all this crazy, wacky, insane central bank intervention that central banks are doing, a 2, 3, 4% move in a single year for a currency against another currency was a big move. Now, that can happen in a single day or in a single week. So the amount of volatility in currency trading is nuts. A lot of this also has to do with the amount of leverage that hedge funds and investment banks use to trade currencies as well. So it's not just the central bankers. You also have the traders reacting to what the central bankers are doing with leverage, setting up insane amounts of leverage on currency trades. Now, about this article, Professor Hanke has some very interesting views on currency devaluation and inflation. So he talks about how inflation is created when a currency rapidly devalues against the dollar. And he talks about how all these countries are having massive amounts of inflation. And these countries tend to be a little bit more honest than the US about their actual real inflation rate. Recently in Nigeria, there was stagflation. The Nigerian government actually admitted that they had high unemployment and high inflation, which is rare for a government to actually admit publicly that there was actual real bad stagflation in their economy. Normally governments don't like doing that. Normally governments prefer stagflate, tax, lie. But the currency devaluation, normally with textbooks, these economic textbooks, what these PhD economists, what Wall Street says about currency devaluation is that it is good to reduce costs and good for cheaper labor. However, that is at best a temporary thing. The more a currency is devalued, especially if the country imports a lot of goods, the cost of goods will continue to increase and increase and increase. The other thing that happens is with currency devaluations in the local economy, labor costs may temporarily go down. However, that currency devaluation, especially if there's a lot of it, starts to leak into the cost of goods sold, into supply chains, into producing goods and services. And then those higher costs in the local or domestic economy then get exported somewhere else. And those costs are normally passed on through supply chains. And we're seeing that in the data when a lot of these global corporations are publicly announcing not only are they having problems sourcing some commodities, but also their input costs are rising substantially. We're seeing big price increases, 6% to 8%, sometimes even higher than that, double-digit price increases for goods and services in supply chains now in a lot of different industries. While government economic data, government economic propaganda in many cases says there's no inflation. This is something to keep an eye on. Again, take a look at Professor Steve Hanke's article here with the nice charts and tables there about currency devaluations of the currencies that have had the worst currency devaluations against the dollar since January 2020. It's an interesting article that I'll link to, and his views about how currency devaluations against the dollar, those countries, it has led to really, really bad inflation in their domestic economy. It also causes much higher costs in their supply chain, and import costs go through the roof as well.